Hello and welcome to this Frontier View webinar. Today we're going to be discussing the outlook for South Africa, the impact of coronavirus on the economy, and of course what comes ahead looking to 2021 and beyond. My name is William Atwell. I'm head of the Sub-Saharan Africa research practice here at Frontier View, and I'm joined by my colleague Matt Kindinger, the associate practice lead for SSA.
Hello, this is Matthew, and I'm looking forward to going through the outlook for South Africa today.
Great. So we're going to first take a look at the expectations for coronavirus, both at a global level and how we expect it to impact South Africa. A couple of, I suppose, underlying assumptions here. The one is that we don't expect coronavirus to go away by the end of the year. It's going to be a lingering threat to global markets and South Africa as well. This is because we don't expect a vaccine to really come online and be widely available before late 2021. And we could actually expect access to vaccines, really to not be available in many SSA markets for some time after that as well. So we still expect more in terms of infection rates. We expect restrictions of one kind or another to remain in place at least to the end of this year and potentially into next year as well. And this is going to affect global markets and, of course, South Africa as well. The economic impact of all of this has understandably been severe, and we've downgraded our forecasts for a number of the major global markets quite considerably, expecting very deep recessions in parts of Europe, for instance, Japan, and as well as big emerging markets like Russia. China, we're expecting the slowest growth rates for over 30 years, really key trading partner for South Africa. So this is, of course, dampening demand for South Africa's exports, both primary exports and secondary exports as well. A bit of a recovery next year, of course, but this is going to take some time. And South Africa is certainly going to be left with some lingering fallout from the global recession that we've experienced in 2020. Looking to really how this is impacting South Africa in a bit more detail, it's important to acknowledge that the economy was already in a weak place before coronavirus hit. 2019 was a weak year in terms of growth, and indeed ended the year in contractionary territory. So a number of industries really struggling, exacerbated in many respects because of the rolling blackouts or electricity outages that we experienced in Q1 and of which indeed resumed in the last couple of months, but lingering structural challenges inherited from the Jacob Zuma years, as well as challenges around things like policy uncertainty, which had really dissuaded businesses from investing. So it's been a difficult time, and this fact that the economy was already in contractionary territory really magnifies the impact that coronavirus and the associated disruptions have and will continue to have on the South African markets. Now, in terms of infections themselves, of course, coronavirus has accelerated over the past several months in South Africa. The market has the highest number of recorded cases, confirmed cases in SSA. Whether this is due to better testing capacity than other African markets is a matter of debate, but nevertheless, it's quite certain that cases have really accelerated over the past several months and actually continue to climb. The one key trend we've noted here is that whereas the Western Cape, and in particular Cape Town, was really the epicenter of coronavirus infections to begin with, increasingly this is now Gauteng, which is really the economic heartland of the country where Johannesburg and Pretoria are located. And so continued restrictions and other disruptions related to these climbing cases would, of course, continue to have a negative impact on the economy overall, both in terms of disruptions due to lockdowns and so on, but also, of course, the confidence effect that rise in cases has on consumption. So this is going to be a challenge that's going to last for some time still. Some of the more rural provinces, fewer cases, but of course, they have much lower population, so that's to be expected. the government's responded to this rise in cases with one of the strictest lockdowns initially in the world. It's level 5 restrictions, really brought the economy to a standstill. Over the past several months and weeks, we've eased gradually to what's now called level 3 lockdowns, where some additional economic activity is allowed, but there's still a range of restrictions in place on things like public gatherings, cross-provincial travel, essentially banned, very restrictive international travel, and continued restrictions on some areas of retail, most notably alcohol sales. We'd expect things to move on to level 2 or level 1 moving forward, but of course that's going to take some time and will depend on the level of infections and the acceleration that we see coming through from the official statistics.
Will, I just wanted to pause there and ask you a question about, level 5 and 3 lockdowns have been extremely disruptive for businesses and clients across industries. That's what we've heard from our clients. Many industries have experienced severe losses, most notably alcohol companies. In your view, is there any indication of when the government might move to level 2 lockdown, and what kind of rules would be relaxed as a result of that?
Well, level 2 lockdowns could actually come into place relatively soon. The government is very concerned about the wider socioeconomic impact that the economic slowdown has caused. Unemployment rising very dramatically, for instance, businesses going under, that sort of thing, extremely concerning. So it's likely that we move to level 2 relatively soon. In terms of what kinds of restrictions might be eased, it's some of those measures I mentioned. Interprovincial travel, probably a bit more allowed there. We know the alcohol and tobacco lobbies been pressuring the government quite considerably because, of course, a lot of jobs are under threat in those industries. So we could see a lifting of some of those bans, as well as a lifting or at least an easing of some of the curfew measures as well. So perhaps restaurants allowed to open a little bit later, people allowed to stay out a bit later, that kind of thing. So certainly not taking all of the restrictions away, but easing the existing ones a bit more, which should, of course, assist a bit of additional economic activity, and we can expect the rest of Q3 and potentially going into Q4 to see a bit of a more normalization of economic activity. So just to, I suppose, illustrate how the restrictions we've seen so far have affected the economy overall, we begin with the consumer environment and looking at retail sales over the past 12 or 18 months or so. We can see, of course, we had a very significant fall, particularly in April this year. Some interesting behavioral trends here. Of course, in April, we saw a spike in certain areas of spending. So actually a double-digit increase in pharmaceutical spending, for instance. And in that category, we would expect that to cover things like hand sanitizers, PPE, face masks, and that kind of thing, as well as people stockpiling to some degree. But of course, across most areas of consumer demand, a real bottoming out and a deep contraction, deep into the double digits across most areas. Coming into the middle of the year, things have started to turn a corner, but still, of course, mostly in contractionary territory. Going into later Q3, Q4, we might start to see things stabilize a bit more, returning to relatively low levels of growth in 2021. But you can see the effect that this lockdown has had on consumer behavior, a real fall off, and of course this is really bad news for consumer goods companies. In terms of the business environment, similarly, we saw PMIs fall to extremely low levels, record lows, particularly in April and May, still in contractionary territory even by the middle of the year when we've sort of already moved to level 3 lockdowns, and businesses across most industries reporting really low turnover, and nearly 100% of industries in areas like construction, trade, mining, manufacturing reporting below normal levels of turnover. So it's really affected every industry across the business sectors. The same can be said if we dig into a bit more detail on the manufacturing side. I mentioned how we've seen real restrictions on manufacturing plants' ability to operate, and we can see that in the manufacturing utilization data. Certain areas of heavy industry particularly badly affected. Food and beverages a little bit less so, I guess, because we're talking about basic staples here. But really across industry sectors, quite a significant fall in terms of their capacity utilization. And of course, this is exacerbated by those electricity outages that I mentioned. Over the most recent electricity data available showing quite considerable contractions in electricity generation. This has to do with those challenges we've seen at Eskom, the state-owned power company, and that's going to weigh on industrial activity as well.
So, Will, that's a very good point. Eskom's travails have certainly been very well publicised. Reforms to improve the beleaguered state power company Eskom have been on the cards for some time. Are there any signs of things improving looking ahead?
Well, there have been a number of, I suppose, sensible appointments to Eskom and also other beleaguered state-owned enterprises over, I suppose, the past year or so. In terms of progress, not much to report, really. We know that the government's continuing to bail out a number of these SOEs, and Eskom's included in that, of course, as well. There's quite considerable political resistance and trade union resistance to making any kind of massive structural changes that could see Eskom perhaps run in a more efficient way. So, really not much progress to report. It's a rather a long-running business, a long-running exercise, and so I really wouldn't see any significant improvement in how Eskom operates, within the next 6 to 12 months. Really, it's going to take a very long time indeed.
Right. So, sort of more of the same for the foreseeable future.
Indeed, and potentially power cuts, well into the rest of 2020 and potentially into 2021 as well. I mentioned the bailouts that the government's been giving to SOEs recently. A lot of media coverage, particularly of South African Airways and its travails, just been a bit of a black hole for public finances. But that's really just one of the pressures on the fiscus and the reasons why debt continues to climb. Of course, the primary reason at the moment is the significant revenue shortfalls that we've seen as a result of personal income taxes, business taxes, VAT, all really falling as a result of the economy entering this deep recession. So revenues falling, but of course, the demands on the government to spend have been increasing. So as a result, the government's been borrowing more, and we've seen a real departure from the initial debt outlook that the finance minister outlined in his February budget speech. So in the supplementary budget that we had in June, which outlined the COVID-19 emergency measures, really, the debt outlook has deteriorated quite considerably. The plan is, by 2022, 2023, to begin to stabilize at least this much higher level of debt, with a view to perhaps by the mid-2020s begin to bring it down. But no serious analysts or forecasters are expecting government to actually achieve that. The political resistance to any fiscal consolidation is just too great. So we would expect actually the debt levels to continue to climb well into the mid-2020s, which does pose real sustainability questions going forward. So I thought we could take a pause here and shift our perspective to looking at the outlook. We've been looking at the impact, the immediate impact of COVID-19. We now look at some of the forecasts and begin by assessing some of the drivers of those forecasts. So what have the authorities been doing in response to this severe downturn, and how does this affect our outlook going forward? So I suppose the first thing to note is the response by the monetary policy authorities, the South African Reserve Bank, and it's really been implementing an unprecedented cycle of monetary policy easing over the past year, really. So beginning in January last year. We had a relatively small interest rate cut, and that's really continued at the beginning of 2020, a successive series of rate cuts, and now going down to 3.5%, which is the lowest for many decades, actually. The idea is this would provide some cushioning for the economy, provide a bit of a softened blow to borrowers. We haven't actually seen credit growth expand terribly, and we wouldn't expect these series of cuts to really affect demand too much either. And this is really just due to the scale of the downturn that we're seeing in South Africa. So providing a bit of a softening effect, but really not stimulating the economy to any significant degree.
So, Will, I just wanted to ask you a question on that, actually. So with the economic outlook still pretty weak and the economy in quite a poor state, but with the repo rate now at a multi-decade low, would you expect any further policy easing over the next 12 months or so?
We would expect potentially one more trim to the repo rate, which would take it down to 3.25. I think increasingly the Monetary Policy Committee is realizing the limits of what policy easing can do, and of course, we in a situation where we wouldn't want to see the repo rate decline to levels that are too low, looking at the impact that might have on the sustainability of the banks themselves, for instance. So I think they're realizing the limits of policy easing, but just given how the economic situation seems to continue to deteriorate through 2020, it's possible that we'd see a further easing just to provide a little bit of additional cushioning. But as I say, it's not going to have a fantastic impact on growth overall.
Right. Okay.
So that's the monetary policy stimulus side. In terms of fiscal policy stimulus, the kind of headline initiative is the government's big support package, which is equivalent to 10% of GDP, and it involves a range of measures to try and provide some assistance to companies and households and the wider economy. So much of this is, of course, directed to things like additional healthcare spending and measures to provide support directly to the sort of anti-coronavirus cause, but also a number of measures, sort of easy credit schemes, soft loans, things like that to help businesses. The effectiveness of those schemes has not been very good from what we've heard from clients. The take-up has been fairly small. So we wouldn't expect this to necessarily help businesses that much, the effect to be that considerable. Although, of course, the income supports, additional welfare spending, that sort of thing, of course, helping to at least see lower income households through the worst of the crisis. So that's certainly of assistance. To put some numbers to this, we had the supplementary budget, as I mentioned earlier, come out in June. And we can see a number of shifts in terms of the government's spending priorities reflected there. So the transfer payments reflected in the additional welfare spending, for instance. We've seen a big increase in the share given to social development as a category, and as well as public health spending as well. So in terms of what these measures mean and how it's affecting the growth outlook, we mentioned how earlier in April, May, we had those real collapse in terms of consumer demand, real hit in terms of the impact on business and government finances. So that's really concentrated the depth of it in Q2. Q3, we're still in level 3 lockdown. We may go to level 2, but that still involves some restrictions, and we still expect the economy to be contracting across most areas of demand in Q3 as well, moderating a bit more in Q4, and then finally returning to growth in 2021. But going into the medium term, 2021, 2022, 2023 as well, growth really remaining at pretty low levels. There's quite considerable fallout as a result of the coronavirus recession. both on public finances, but also challenges such as unemployment we expect to remain very high, going into the 2020s, leaving scars on the economy that will last for some time.
Will, I wanted to ask you a question actually about the outlook for South Africa's economic growth. So clients are, of course, concerned about the scale and pace of the recovery in South Africa, not least because the market is, it tends to be the primary driver of sales and profitability for their SSA business. It's much more sophisticated and much larger than other SSA markets. Could you give us a sense of when you think things will get back to normal, if indeed they ever will get back to normal?
Yeah, well, I think here it's useful to perhaps step away from the year-on-year GDP growth number, which is what gets reported and gets people excited. And here we see growth numbers that surely must be good, but of course it's coming from this very, very low base. So any economic activity is going to sort of look like positive growth. I think what's useful here is to index the growth index GDP in local currency in the rand to 2019 levels. So if we say 2019 is 100, of course 2020 is a significant fall in terms of the scale of economic activity, if you will. But even when we have some growth, this still doesn't mean we actually get to 2019 levels yet. Even by 2020, with some further growth, we're still not at where we were in 2019. So this means, of course, multinationals are really going to have to adjust their expectations for this market. We would expect a real shrinkage in terms of the addressable demand in certain segments and industry verticals, for instance, and challenges that are going to persist, well into the mid-2020s, really, in terms of customer behavior, pricing, things like that. It's going to be quite a different environment to before coronavirus.
Yeah, well, I was going to say this is a really powerful slide because, as you were saying, growth figures may look really impressive in 2021 and 2022. May provide some reassurance, but this really does give you an idea of how much the South African economy needs to catch up by just to get back to 2019. So yeah, really powerful slide.
Indeed, and it goes back to those pre-existing structural weaknesses that were mentioned at the beginning, really magnifying the impact that the global and regional and local downturn has had on the economy, leaving sort of lasting challenges that are really going to persist into the medium term. Looking at the outlook across different industries, I suppose GDP and the economy as a whole is one thing, but we really expect quite a varied patchwork or very uneven pace of recovery across different industries. Understandably, areas like hospitality and tourism really struggling for much longer. If you look at the international statistics and also some of the surveys that have been going on, many people not really expecting the international aviation and hospitality industry, tourism industry to return to pre-coronavirus levels for even up until 2023, we could see underperformance. So certainly South Africa being typically a long-haul destination for most Chinese, European, American tourists, really going to be quite difficult to get them back to visiting the country, taking that long-haul flight, particularly given how coronavirus is still going to be very much a risk in South Africa, even up until the end of the year and potentially even into early 2021. Other industries, of course, likely to recover a little bit sooner. Consumer industries still struggling, of course, but as things ease further, as we move towards lower levels of lockdown restrictions, demand not picking up, but at least normalizing somewhat in that direction. Mining likely to experience some challenges, well into 2021. Very severe lockdown affecting that sector in the middle of 2020, but challenges moving forward as well. Construction also taking a very long time to recover. But some other areas, of course, have benefited even from this environment. We've seen a real takeoff in terms of e-commerce in South Africa. It had been a bit of a lagging industry, or certainly lagging global trends for some time, but now we're starting to see a real uptick there. And of course, any technology companies, software providers, companies able to provide the architecture for those kinds of systems. Really a lot of opportunity at the moment. And I suppose the same could be said for areas of public procurement related to the coronavirus response, to notably in the healthcare space. So to, I suppose, start to round out our forecasts, expectations for the Rand. The Rand has experienced very severe volatility in the first half of the year in particular, along with other major emerging markets, currencies, the Turkish lira, for instance, Mexican peso, Brazilian, Russian currencies as well. Also a lot of volatility. This was really driven by this sort of flight to safety that we saw, particularly in Q2, as coronavirus really hit sort of major developed markets in a big way. We started to get an idea of the scale of the crisis that was befalling the global economy. So we had this flight to safety, and that certainly hit emerging markets in a big way. The Rand has since gained a bit more against the dollar, and we expect, of course, continued short-term fluctuations, short-term volatility, but the general trend in H2 is towards a little bit more stability in the Rand, recovering a bit more ground in 2021. The impact, of course, of interest rate cuts, much weaker exports, and further downgrades in terms of the outlook for South Africa's sovereign credit rating, not really helping the Rand either. And so you can see, even going into the medium term, we don't expect the Rand to kind of regain where it was in 2019. But at least the sort of scale of depreciation is lessened and starts to moderate, introducing a little bit more stability, at least for companies trying to do some planning into the medium term.
That's really interesting. Well, so as you say, the Rand is going to regain some stability into 2021, which is a good thing for business planning. That's under a base case where coronavirus comes under control and the wider economy begins to recover.
Yeah.
If I'm correct, yeah. And but the big question is, what if this doesn't pan out as expected? So, for example, if there's a major second wave, or the global economy remains much weaker than we are expecting as our base case.
Yeah, no, this is a very difficult time for forecasters. The goalposts keep changing, and although we know a bit more about coronavirus and the kinds of impact this has on global markets, we're still in the process of learning as well. So second wave remains a very real risk. In South Africa, we're still in the first wave, but in Europe and North America, the risk of a sort of winter second wave, very much there, and could send our global forecasts even lower potentially. Should that occur, of course, we could see a repeat of that Q2 flight to safety in international markets, potentially see the Rand crash even more. So we definitely encourage clients to plan using scenarios. Just represent here the sort of simplified scenario framework we use for South Africa, and as under a downside where we do see much more difficulty in terms of containing coronavirus, potentially much worse situation for the South African economy. Rand falls much more, and also growth actually slides. We could even see a double-digit recession in South Africa, which would be unprecedented. So we definitely encourage companies to plan using scenarios, develop contingency plans to try and mitigate some of the losses that would bring about. Talking about scenarios, I'd also emphasize what an upside scenario for South Africa means. Say we're already seeing China start to pick up some pace, but say the economic downturn in North America and Europe and the rest of SSA isn't as bad as previously thought. Under an upside scenario, we still expect a recession in South Africa. So I think it's even if we start to see some of those positive signals, companies shouldn't get too excited. We would certainly encourage them to plan for a recession, under any scenario, but in particular taking care to plan for a downside and what that could mean. There are other sources of risk as well beyond the headline forecasts and the growth outlook. Even under a base case scenario, there are a number of regulatory measures that are on the books, which we encourage executives with South Africa business to keep an eye on and to plan for and to try and get as much visibility on as they can. Just to flag a couple of them here, some of them have been very concerning for investors and businesses with teams on the ground and investments in the market. Black economic empowerment has been a sort of hallmark of South African economic policy for many years, since the end of apartheid, and of course driven by very real needs to address inequality and racial inequality inherited from the apartheid era. But of course, the way it's been rolled out does create a lot of uncertainty for businesses, additional costs in some cases. Under the current Ramaphosa administration, if anything, the coronavirus downturn has increased political appetite to implement BEE even more strictly. So very important for companies to keep an eye on how that is developing. And if necessary, look into ways to partner with local companies, local Black-owned partners, can help them to navigate the next phases of BEE more effectively. One sort of newer area has to do with how the government's planning to fund its big infrastructure scheme, which is part of its post-coronavirus recovery program. We don't expect this big infrastructure scheme to be sort of rolled out in its entirety. The fiscal resources simply aren't there, but the government is looking at pots of money that it hasn't dipped into before to try and fund some of these projects. And one of the areas that's been mooted is potentially dipping into pension pots, whether the public pension fund or private pension funds as well, creating rules requiring pension funds to actually allocate money to some of these government-driven schemes, which of course creates a huge amount of risk, and we could add to some of that FX volatility that we mentioned earlier, which is very much bound up with sentiment towards South Africa and its risk profile. An area sort of potentially offering both risks and opportunities is the NHI program, which is the government's kind of headline healthcare initiative. And here the NHI certainly is going to allocate additional public resources to public health, potentially additional procurement opportunities in the public health space, but of course significantly increasing the power of the state in the public health system, which could of course put multinationals, particularly foreign drug companies, for instance, on the back foot, make it much more difficult to negotiate around pricing and so on. So that's another one to really keep an eye out on. We don't expect the NHI to be rolled out again in its entirety. The fiscal resources simply aren't there, and if anything, fiscal resources are more squeezed than ever. But aspects of NHI are likely to be rolled out, going into 2021 and beyond. Talking about reforms, one of the big headline items of the last couple of weeks has been the government's agreement to an IMF loan. There's been a lot of talk about what this could mean for perhaps more pragmatic reforms. This initial IMF loan that was agreed recently is specifically targeted at helping the government to deal with the coronavirus fallout sort of in the immediate term, and doesn't come with particularly strict strings attached, although the government does need to report on it on a regular basis on how those funds are being spent. Looking ahead, just given that debt trajectory, that sovereign debt trajectory that I mentioned earlier, where things start to look rather unstable, it's very probable that the government could actually go back to the IMF, which is starting to raise questions about, could the government then start to implement or become a bit more amenable to more pragmatic reforms, potentially reducing the scale of the public sector wage bill, perhaps introducing some of those liberalizing reforms that economists have been calling for many years. And And unfortunately, sort of the short-term answer is no. The balance of power, both in the cabinet and in the ruling party, does not favor pragmatic, sort of pro-business, pro-growth reforms. We know the president has been sitting on the fence for some time regarding cleanup of the SOEs, for instance, as well as tackling corruption. There hasn't been much progress made. And within what's called the top 6 of the ANC, which are the sort of most senior positions, actually, it's quite finely balanced between those who are of the more leftist, populist persuasion and those who are a bit more amenable to reforms of one kind or another. So we certainly wouldn't expect too much in the way of pragmatic reforms. Likely, there'll be a bit of a stalemate when it comes to negotiations with the IMF. We don't expect reforms to really come in to play in the medium term that would really help the economy to pick up in any significant degree. And that's why we don't expect growth really to rise beyond sort of 1.5–2% in the medium term. Those structural challenges to do with the policy uncertainty and the business environment really to persist for many years still. Great. So I suppose coming out of this analysis, there are a range of business implications for companies to consider, looking across pricing and the impact of FX volatility, product portfolios, taking into consideration how particular segments might shift, particularly consumer segments potentially trading down as incomes come under further pressure, channel implications as a result of the uptick in e-commerce, and of course, continuing operating challenges to do with electricity challenges. We would encourage, of course, companies to take advantage of whatever support schemes there are for businesses. We know some of those soft loan programs haven't been that easy to access, but we would encourage companies to work with their local partners, to approach local banks, to take advantage of those loan schemes where that would help to further some business continuity and at least wait things out until the recovery, because we know that the companies are very much in sort of crisis mitigation and survival mode for the time being, until at least there's a bit more momentum in the economy. So a number of areas to consider in terms of practical business considerations into the next several months and into next year. This will all be available on our Frontier View portal, and of course in this recording as well.
Well, thanks very much, Will, today for walking us through walking through our analysis on South Africa today. Given the stresses that multinationals are facing at the moment, this has been really helpful in providing some much needed clarity and guidance on where South Africa's economy and business landscape is heading over the next couple of years. So thanks very much for that.
Sure.
So for listeners, just a reminder, our clients can access all of our South Africa analysis and resources, including our latest macro analysis updates, in-depth research and scenarios on our Frontier View portal. And before we draw this session to a close, we'd also like to encourage listeners to download the new Frontier View mobile app. This will allow our clients to receive our latest views and commentaries straight to their smartphone. So much more convenience and really easy access to our latest insights.
Great. Well, thanks very much for joining us today. As Matt mentioned, there's more resources available on the Frontier View portal. So please go ahead and access those. If you're looking for further guidance, please also reach out to your client services director, who I'm sure will be glad to assist as well.